Hello, everybody. So today I want to talk about options and specifically the options wheel on volatile stocks and today on HIMS. I did a similar video with MicroStrategy, and MicroStrategy, of course, is the king of volatility, even more volatile than HIMS. But actually, HIMS's volatility is not too shabby. You can see implied volatility here is 84%. And if you're bullish on the stock, I think cash secured put are a great way to acquire a stock you're already bullish on. Of course, this is no financial advice, but this is kind of how it works. Let's say you have a cash to buy HIMS. HIMS is trading at 28, but you don't quite want to pay 28, right? Because you're cheap. You want to pay 25. And so what do? Well, you can sell a put. You can sell a cash secured put, and that cash secured put is going to pay you $48. So when you sell that put, you're going to receive $48, and in exchange for that, well, you have the collateral. You need to have $2,550 of collateral, right? Because it's a $25.50 strike price. So you need to set that aside. You can't use that money for anything else anymore. Now it's like collateralized. It's blocked by your broker as collateral. And it's going to be blocked for 9 days, and you get the 1.88% up front. The $48, if you do $48 over $25.50 as a percentage, that's 1.88%. So you're getting paid 1.88% to block $25.50, which is your collateral of your promise to buy HIMS at $25.50 if it were to drop below 25.50 or at 25.50, then you have to buy it, and typically these things get exercised on the last day, typically, and so you're selling a contract. That's effectively what you're doing. You just sold a contract and you made $48, and that may not seem like much, but it's only over a 9-day period. And then you may say, oh, well, that's really nice, but I see the chance of profit at 78%. So BTD, that's really nice, but really 1 out of 5 times you'll be assigned the stock. 1 out of 5 times you'll have to buy the stock. You'll be forced to buy the stock, and so that's foolish. Well, you'll be forced to buy the stock at $25.50. So if you were planning on buying the stock at $25.50 in the first place, you're going to be very happy about that. If you were bluffing and actually you sold the put, but you had no intention of owning the stock, then for you it's a win-lose situation. But it's a win-win situation if you get the deal that you were willing to get in the first place. That's why I say it's a great strategy to enter a stock while still collecting a premium. So let's talk about this hypothetical scenario. So let's say you're going to do cash secured puts on HIMS. And so the first 9 days, you write that put, and let's assume the numbers stay the same week after week. So the first 9 days, you write that put and you earn 1.8%. You don't get assigned. So you do it again. You don't get assigned. Your put expires worthless, so you get to keep the whole premium. But you do it again for a second 9 days, and you earn another 1.8%, and you don't get assigned. So you do it a third time for another 9 days, and you earn your 1.8%, and you don't get assigned. And remember, the odds are 1 in 5 you get assigned. So let's stay on the fourth time, the 9 days, right? So towards the end of the month where you've been doing this, you get your 1.8%, but boom, you get assigned at that end of the month. So in that example, you're forced to buy HIMS on the fourth go around, and you're forced to buy him at a roughly 9% discount. In my example right here, it's roughly a 9% discount. So you're forced to buy it at a discount. And so if you think about how much money you've made with this strategy, with this cash secured puts as an acquisition strategy, you've made 1.8% 4 times, plus the 9% discount for when you were actually assigned. So you got it a good 16.2% discount. So On a volatile stock like HIMS, where you're not going to get peanuts, where you're actually getting, let's say for a 10-day period, you break the 1% yield for 10 days, and you could only get that on highly volatile stocks, this pays you something, right? And writing cash secured puts are actually advantageous in this situation to acquire a long position. Now, of course, you may not be able to time it perfectly, but if you're a long-term investor, in my view, that's an advantageous way to acquire stocks, and I acquire stocks like that sometimes. Sometimes I do it, although it is an active strategy. I'll get to the drawbacks in a second. So let's say you're not like me, though. Let's say you don't want to hold HIMS for the long run. Well, you got a sign. So you got your 100 shares of HIMS now. Now it's time to turn the wheel. You turn the wheel, and it's covered call time. So you're going to write options now. Call options you're going to write on the stock that you already hold. And so how does that work? Well, let's do a similar thing. So the stock is at 28, and let's say now you're going to start writing options on that stock, selling calls. You're going to sell calls. And so what you do, if you sell a call for a strike price of 30.5, the stock is trading at 28 right now, so 9% above. You sell that contract, you say, yeah, I'll sell HIMS to you for 9% more than it's worth now. And to sell that right to someone else, you're going to earn $45. So $45 on how much collateral? Well, it's not collateral anymore. You own the stock, but it's on the $25.50 of stock. So on $2,500 of stock, you're earning $45. And so you can see you get a similar yield, but this point it's not cash anymore. At this point, it's just the stock on which you earn the yield. And so you're going to get $45 over a 9-day period. That is 1.76%. And 1.76% over a 9-day period. There's about 40 times a 9-day period over a 1-year period. So that's a 70.4% yield potential on this one. So that's quite outstanding if you ask me. A very high yield. And you lose your stock, of course, once again, you lose it 1 out of 5 times. And so when you lose it, you still make an 8.9% gain, but you lose it one out of 5 times. And so on the cash secured put option, by the way, I didn't read that, but that was a 75% yield potential for the year on this example. And so whenever you get into that volatility in the 80-90% range, you're going to get these very, very high yields. And so let me finish with the conclusion. So let's assume you sell the put on the cash, sell a put. Then you get assigned, and then once you get assigned, you sell a call, and then you get called. And in between those two, you earn it all at once because it would reset at the lower price you're forced to buy it at, but you also earn 8.9% gain on the stock. So that juices up your yield. So in just about 2 months, I'm making this calculation for the sake of simplicity, but in just about 2 months, you made 1.8% times 4 plus 1.76% times 4 plus the gain on the stock of 8.9%. So that means in about 2 months, you made 23.4%. Now, of course, there is 6 times 2 months in a year, and so I'm taking a 5.5 multiplier here because it's actually 34. It's a little more than a month, so I'm assuming a little less. But anyways, over a 12-month period, this strategy theoretically could yield above 100%, roughly 128%. Give or take 10% with the strategy. So that is the idea of the wheel. And now I may hear you say, "Oh, well, that is too good to be true." Well, first of all, remember that earning that on HIMS is actually less than what the return has been for the past 2 years, because we on this channel we started talking about HIMS at around $6 to $7, right? And the stock right now is 28. So over a two year period, you wouldn't have quite multiplied your money like you multiplied your money by just buying the stock cheap. So keep that aside, keep that thought aside for a second. This is an income strategy and called an income strategy for a reason. But there's other drawbacks, and we're going to talk about the drawbacks of this strategy, answering the question, is this too good to be true? Well, first of all, to start, you need 100 shares. So for him, it's not that big of a deal, right? Because it's a $25 stock. But if you start doing this, in companies that start trading in the few $100s a share, if you just get it started, you can't do that, right? If you're eyeing a $400 a share MicroStrategy, well, if you're just getting started in life, that's $40,000. You can't really do that. So that's the first thing. First is you need at least 100 shares. Second, you need the time. It's a very active strategy, right? You gotta be on your broker, at the beginning of each week or each 2 weeks or each month, depending on how you want to do. You gotta be on your broker and sell the calls or sell the puts, depending on where you are, at which stage of the wheel you are. But it's very active. And because it is very active also, the way it's going to be treated in the tax code is going to be treated as a short-term gain. And short-term gains are taxed at your income bracket. And so, in the US, it could, after a certain income, it's 39%, 39.6%, right? So that's a steep taxation. Now, if you're just getting started in life and you don't pay any taxes, or you don't have any over income, short-term taxation may actually be helpful. In some instances, it's lower than capital gains, but that's really when you're just getting started out. More people will be impacted by the 39.6% tax rate in the US. I can't imagine what it is in other countries. It's probably much higher after $400,000 a year. So anyways, that's the problem. You're gonna have to pay taxes. It's a problem. Now, a fourth problem of this is you're vulnerable to stock price swings. So what do I mean by that? I mean it's extreme short-term volatility can really hurt your performance in this strategy. So let's say you wrote your cash secured put, you earned your 1.8%, you agreed to buy HIMS at $25.50, and then boom, you're out of luck. There's a short report. I don't know, the CEO is seen as a black car. The short is saying that the CEO is in a mafia because he drives a black car, something like that. Boom, the stock drops from $28 to $18 in just a few days because of a short report. Well, in that case, you'd be forced to buy at $25.50. And I would see this as lesser of a problem compared to the other problem, which is you're long the stock. You want to hold it for a generational hold. You want to hold it for more than 10 years, and it goes from 28 to 45 in 9 days, and you had sold a call. So unfortunately, because you had sold a call, you're forced to sell your stock at 30.5. And in that situation, that would be really annoying and unfortunate. And of course, in both situations, by the way, you can buy back the put. You can do that, but the economic loss is the same, because if you want to buy back your call, you're going to pay a fortune. So the economic loss is going to be the same, even if you say technically, I get to keep my shares, but I bought back the call. Yeah, you can do that, but it would cost you an arm and a leg if the stock was shooting to $45. So in conclusion, this strategy of the options wheel is not for everyone. But I see the value for retirees. I see the value if you don't have a full-time job. There's a lot of good things to be said about it, but it's just not for everyone. It's a very active strategy, and it's not quite trading. You're not exactly a trader, but it's still an investment because there's an underlying asset and fundamental analysis. But you're getting a little closer to doing trades here. But me personally, and I'm a long-term investor, I enjoy cash secured puts to acquire long positions, because a cash secured put you don't have an unlimited loss to the downside like you potentially have with a call, where you could lose, i.e. give up tremendous opportunity if you buy a stock that just ends up shooting up and you get called out of the stock. But cash secured puts require long positions. If you're not in a hurry, if you already have a big position of a stock, I find that a very good strategy, at least for me. And of course, on this channel, it's just about what I do. I only document what I do. This is not investment advice, not financial advice. This is just entertainment. Hoping you were entertained. Please like, please subscribe, follow me on X, follow me on Patreon. Expect more on options on Patreon. I'm going to publish more stuff about that. And have a wonderful, wonderful day.